market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London, in for Francine Lacqua. We have US equity futures edging higher after that weak US jobs openings data reinforced bets on a Fed cut later this month. We've been hearing from the Fed's Alberto Mussolem signalling that he thinks current policy is in a good place.
The current modestly restrictive setting of the policy rate is consistent with today's full employment labor market and core inflation nearly 1 percentage point above the Fed's 2% target. Looking ahead, I expect the labor market to gradually cool and remain near full employment, with risks tilted to the downside.
Well, let's talk more about those hopes for Fed easing and markets. Joining me now is Henrietta Pacquement, Senior Portfolio Manager over at Allspring Global Investors. Welcome back, Henrietta.
Good morning.
We've got this reprieve for treasuries, but how fragile is it?
Well, I think what we're seeing now is a bit of a body of information on the labour market in the US coming in weaker. So I think that is helping put a lid on rates, that's starting to be reflected in the market. That being said, we've got two big numbers coming up, so it'll be interesting to see how that plays out.
Yeah, we do indeed. So for the payrolls number, is there any sort of print that could put 50 basis points on the table?
So I think increasingly market participants are looking at a number of metrics, not just the jobs number that is coming up tomorrow. So they will take it into account. I think for it to sort of move the expectations that are priced into the market, it needs to be a big miss or gain compared to what the expectations are at the moment.
But is a quarter point cut so well telegraphed at this point that no data point could take it off the table?
I think it's going to be tricky at this stage. Again, the data point that is coming in next week on the inflation side is going to be interesting to watch. But again, I think it needs to be a big miss really to get us off track for that 25 basis points.
So what sort of duration do you like along the curve then?
So at the moment, our preferred area of the curve is probably the intermediate space. That's an area where you can benefit from the rate cuts as and when they come, but you don't necessarily have quite the volatility and the dynamics that you've got on the long end of the curve. If you look at performance year to date, that has played out to our favour, so that remains for the moment our preferred location in the curve.
OK, and we've got Stephen Miran's nomination hearing happening later on in Washington. I wonder how much of the Fed pricing accounts for the political pressure that we've seen on the Fed.
So I think, unfortunately, the political pressure is there. At this point, given the numbers that we're seeing in the labour market, they've got to get out of jail card, as it were, because they can look at responding to market conditions. So I think it is playing in the long end, and it is sort of creating volatility at this point. But I think it's probably a stretch to say that the independence is an issue at this point.
And if we can bring it to the UK, because we had Bank of England Governor Andrew Bailey warning about Fed independence as well yesterday. We've had these wild moves at the long end of the gilt curve as well. We were talking to Eric Lonergan over at Calibrate, and he says it's more about investor psychology than actual fiscal concerns. What do you make of that?
Well, the UK is in a completely different situation to the US. There we're looking at sort of structural issues, but you are looking at a government that is looking to address the deficit. And then there's a bit more of a supply issue that is hitting the UK. So I do think there is an element of confidence and market behaviour when you start looking at the UK. And I think maybe a bit of memory of what happened a few years ago.
PTSD of 2022.
PTSD of 2022. Though I think the market conditions are completely different because you had some embedded leverage in the government market that is no longer there in the same way in the UK markets.
But you have Bailey saying ignore what's happening at the long end of the gilt curve, basically. But do you actually need to have fiscal and monetary policy working together a bit more here?
I do think that they need to work together, obviously, because of the sort of twin deficits in the case of the UK. But I think if you look at the UK, they need to balance confidence and getting the growth going and getting sort of market spirits up, as well as dealing with the deficit. So it's tricky, more structural, longer-term issue that they need to deal with.
Yeah, it's hard to get growth going and get out of the doom loop if you raise taxes again.
Correct.
But just back to the Bank of England, what should they be doing then? If they should be working more closely with fiscal policy, does that mean ending active gilt sales? What's the role here?
To be fair, they are very sensitive to the technicals in the gilt market, and we've seen them time and time again intervene if they feel that the market is getting out of hand. And I think that kind of behaviour is going to continue. But then, from a rate-setting perspective, the UK is still in a situation where inflation is still quite high, so they have to bear that in mind in their views going forward.
I mean, do you write off rate cuts from the BOE for the rest of the year? Now we've heard from the MPs.
I think it's going to be tricky, and if you look at what's priced in at the moment, there's not a lot priced in to any of the European curves, actually, at this point.
And just finally, I mentioned this warning from Andrew Bailey about Fed independence, attacks on it from President Trump. What actually is the consequence for central banks and for markets this side of the Atlantic?
The Treasury market is a big one.
Yeah.
A lot of markets in the world take their cue from it, not just in Europe, but globally. So it is a key market. On the independence piece, it is sort of harder than is maybe at first blush. It is a committee. A lot has to happen for that independence to be really effectively changed.
Yeah, I just wonder how much of the premium is accounted for by that and how much the fiscal concerns. But Henrietta, really good to talk to you. Henrietta Pacquement, Senior Portfolio Manager at Allspring Global Investors. Now, elsewhere in these markets, we've got Chinese stocks slumping today as regulators in Beijing weigh measures to cool stock market speculation as their concerns mount about a rapid $1.2 trillion rally. What a problem to have. Let's bring in Bloomberg's Ros Matheson for more. Ros, is the mere threat of speculation curves enough to control the froth? Looks like it today.
Well, we are seeing an immediate market reaction today, but this is a market that was lagging for a long time and then suddenly in August sprung to life and is looking quite a bit frothy. I mean, it's interesting that authorities seemingly were happy to let that run over the past week or so because Xi Jinping had some very big events going on in China, hosting a lot of leaders from around the world. And we know that the Chinese do like to turn on a good show. And that's not just about the leaders being there and the military kit that was on display, but the markets looking positive. And so they may have been quite happy to have that continue through that period. I mean, they like to make sure that the pollution's not too bad in Beijing. Markets are looking positive in those moments. But there is quite clearly from our own reporting a sense of concern about this. And so what they want to do is just turn down some of the speculation. Perhaps, they loosen some of the curbs on short selling, for example, but they don't want a massive collapse in the market. They've been there before where it's gone very up and then very, very down very fast. And clearly, from our own reporting, what we're hearing is that what they want to do is just manage the market a little bit more carefully, perhaps have it continue on a positive trend, but on a slower burn than that, because the earnings, trajectory from companies doesn't really bear out necessarily where these stocks are. So a concern about that disconnect. And certainly the messaging is that they don't want the market to turn rapidly lower. What they want to do, perhaps, is just slow down some of that froth a little bit.
And if we can turn Ros back to Washington, we've got Stephen Miran's Senate nomination hearing for the Fed's Board of Governors this afternoon. I'm sure he's going to pay an awful lot of lip service to Fed independence, but do you reckon it'll be seen as hot air?
Well, we do know ahead of time what he's going to say, and he's actually been saying it in recent weeks when he's having his conversations with different officials in Washington, which is, yes, I fully respect the Fed's independence. He's been saying that line now for some days, if not weeks. But the optics of the hearing are going to be very interesting because it is against that backdrop of Donald Trump trying to reshape the Fed more broadly. There's quite a lot of anger amongst Democrats on this banking committee about what's happening with Lisa Cook and Donald Trump's moves to fire her. But the question is, do the Republicans do or say anything? It doesn't seem any of them are really inclined to raise the hackles of Trump by trying to block this nomination. Do they show any concerns in their comments in the minute? The Democrats don't really have enough to kind of slow this down. So it does seem, regardless of whether he's saying this now because he's trying to get over the line or whether he really believes it, it's possible he'll be confirmed before that next Fed meeting in a couple of weeks where rate cut rate cut is very much on the table either way, but clearly he is also someone who will be attuned to Donald Trump's thinking where rates are. But for now, he's saying, to colleagues and no doubt at this hearing today that he's a true believer in Fed independence.
All right, well, we'll have full coverage of that hearing right here on Bloomberg TV. It's about 3 p.m. London time. But Bloomberg's Ros Matheson, for now, we thank you so much. Now, I want to get back to China because we have some breaking lines on DeepSeek, the AI race hotting up. DeepSeek saying that it's targeting the release of its AI agent by the end of this year. Of course, earlier on today, we've had the news that Apple is eyeing Spring to launch its new web search tool for Siri, again, to rival OpenAI. This adds another element to the mix. So they're building this AI model. It's designed to carry out multi-step actions for you with not much direction from the user. This, according to people familiar with the matter, it is a Bloomberg scoop, and it's also meant to learn and improve on its prior actions, they have said. Of course, we know that DeepSeek upended the global tech industry back in January with the release of R1. They're pushing for this new software to come out in the final quarter of this year. So potentially getting ahead of the game when Apple comes out with its web search tool in the spring. But let's get back to the geopolitics now. European leaders expressing concern that Russia will mount a new offensive on Ukraine as they discuss security guarantees for the country with President Volodymyr Zelenskiy. This as Russian President Vladimir Putin has said that Zelensky should meet him in Moscow. Well, we can go now to our Europe correspondent, Oliver Crook. He's got the latest for us. Ollie, in this meeting of the coalition of the willing, how practically willing will they be to back Ukraine when we've got a ceasefire looking more and more distant?
Yeah, well, that's been the big question from the beginning. I'd say there's two real parts to this meeting. The first is to define what the willingness of the coalition of the willing is. This is something that we've been discussing for a number of weeks. We've been talking for a very long time, particularly with the Trump enthusiasm for getting a ceasefire and an end to this war, what the day after looks like. And these are conversations about the day after, what the so-called reassurance force in Ukraine could look like. This is something that could be spearheaded by Western troops that would be in Ukraine, to monitor, potentially also to keep peace. But again, these things are really sort of ill-defined in terms of what the willingness of these countries are to commit troops to this, what their exact function will be. So that will be a sort of large part of the conversation. The other key part of the conversation, Lizzie, though, is a question about peacekeeping forces after a peace is completely irrelevant until there is peace, or there is a sort of indication that peace is possible. And at the moment, that is not the indication that we're getting from Vladimir Putin right now, which is why it's so crucial for these European leaders to speak to Donald Trump when they are all assembled, and they intend to speak to him a little bit later in this afternoon to try to get an idea of where his sort of thinking is with Vladimir Putin and try to appraise where he stands with Putin and where he thinks that Putin's intentions are. What they are hoping to have is from Donald Trump this idea that the Europeans have been convinced by for a very long time since the beginning that basically Putin is just playing for time. He's not taking this any seriously. We've seen, over the last few weeks, huge amounts of missile strikes and drones. Does that sound like somebody that wants peace? In addition to the fact that we're hearing from Zelensky over the last couple of days that there are about 100,000 more Russian troops massing on the sort of edge of the part of the Donbass that Russia does not yet collect. Again, are these all efforts that Donald Trump thinks Vladimir Putin has any indication that he is willing to enter into any serious negotiations around peace? That is going to be for Donald Trump to appraise, and it's something we know Donald Trump is thinking about. We've heard from him over the last 24 hours. He says that he'll know whether or not he'll be happy with Putin in the next couple of weeks, depending on what Putin does. We should say, Lizzie, just as a final point, the broader context for this for Trump, and you can tell there is a little bit of anxiety mounting around this. The last 72 hours for geopolitics has been absolutely spectacular. That military parade that we saw in China, we see Putin hugging, embracing Kim Jong-un, we see him holding hands with Modi. These are all things that are go into the calculus for Donald Trump, and the Europeans are hoping that it's a calculus that will end ultimately, finally, in their favor.
Well, we're looking at the steps of the Elysee there. I wonder how much hand-holding Emmanuel Macron will be doing with those other European leaders in Paris. We await their arrival ahead of the start of that meeting at 9:30 a.m. Oliver Crook, we thank you so much for setting us up for that meeting. Now, to some other news, sad news out of Europe. The Portuguese government has declared a national day of mourning after 15 people died in a tram derailment. Local media say that the cable that supported the tram car snapped, sending it crashing into a building. At least 23 other people were injured in the incident, and the tram is a popular ride for tourists. It was classified as a national monument more than 2 decades ago. Well, coming up on the programme, as Monte Paschi reaches the minimum shareholder level required to buy competitor Mediobanca, Italian banking M&A is back on the table. And we're going to discuss the sector with Jackie Ineke with Spring Investments. That's next. This is Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
This is going to get Wall Street's attention.
They're not going out and hiring a ton, but they're also not firing. So basically, you have a frozen labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Financial conditions versus economic conditions. There's a key distinction to make.
And that really is the key question for policy going forward.
The August Jobs Report. Friday on Bloomberg. Context changes everything.
Banker Monte Paschi has paved the way for it to take control of its rival Mediobanca. That's after it broke through the minimum acceptance level it had set for its plan to buy the Milan-based investment bank. Now, the combination would create Italy's third largest lender. And to discuss European banking M&A and the wider banking landscape in general, I'm pleased to say we're joined by Jackie Ineke, CIO of Spring Investments. Good to have you, Jackie.
Thanks. Good morning.
We should start in Italy, shouldn't we? Because it really has been the backdrop to many of the M&A bids that we've seen in the past year. Do you think, though, that Rome has killed off the momentum, potentially, in European banking M&A?
I think, Rome also, you could argue, Berlin and also Madrid has killed off the potential. But I think, you've had the government push back in all those three places. I think the European Commission has powers to
Should it
stop
use them more?
Well, that's the thing. They wrote a sternly worded letter, I think, to the Italian and the Spanish governments. And there is it looks like there's kind of a contravention of the European merger regulation, that's for sure. But, of course, Europe moves slowly. And I think this M&A moves fast. And you had a lot of commentating from politicians, one saying, the EU should stay out of this. Another one saying, using the golden powers in Italy against UniCredit in its bid for Milan has helped the French banks. What's going on here?
Well, do you think that it's the case that you need to get one of these big mergers over the line before you can get EU banking union to really gain momentum?
I'm not sure, really. Honestly, I think there's a lot of consolidation still to go within countries at the lower level, at the smaller level. You don't have to go for the massive banks to be doing cross-border consolidation. I think that's pretty much, it feels off the cards for the next few years still. But there are still thousands of small banks that issue loads of debt that are being bought by the larger banks. And that seems to be absolutely fine. Obviously, Monte and Mediobanca, they're still big banks, but that went through kind of no problem, essentially, in the end.
But on the bigger question of capital markets union, why do you think that the EU is dragging its feet when you've talked about the benefits, potentially?
Yeah, I think what Europe always needs is a crisis to move forward. And I think we've talked about capital markets union since 2015. And then, I've been doing this a long time. And then again in 2017, 2020. But what you've got now, you've got a host of political strength behind this. You had the Draghi report last year. You've got Lagarde talking about it, von der Leyen, launching consultations. And I actually think that we're making progress now. And, we've had banking union, 2/3 of it, let's say, a supervisor, resolution authority. Capital Markets Union is a little bit on a back burner, but we've got Savings and Investment Union coming forward. And there's been a big step forward there. In June, you had the changes or proposed changes to securitisation. Now, if you're going to take that kind of 9 trillion euros of deposits sitting at banks doing nothing and repurpose it across Europe, you need this, you need securitisation to work more easily and freely. And that's what's happening now.
But you do wonder how much that overcapitalisation is holding back returns.
You mean the overcapitalisation at banks?
Yeah, and how much it's holding European banks back from competing with Wall Street?
Yes. I would say as a credit investor, I'm quite happy that the banks are overcapitalised. But, that's also what's driving M&A. So, I think, you know, securitisation rules are being simplified. I don't want to be deregulated. That's maybe a bit too strong. But in the meantime, you know, that will take some time. But in the meantime, you've got banks using their capital to buy other banks. You know, we're talking about UniCredit with Milano and Commerzbank. That's tricky. BBVA Sabadell, but there's plenty of other stuff going on at a lower level, and that's helping competition in European banks.
I also want to talk about the extraordinary demand that we've been seeing this week for corporate debt. European banks' AT1s, you know, one of the most outperforming financial assets on the planet. Is it the case that investors are underestimating the extension risk here?
No, I don't think so. I know there's a lot of kind of hand-wringing about AT1s. I mean, this is my specialisation and what we invest in at Spring. But, you know, we're at tight levels, spreads are tight, but European banks are as strong as they've ever been. And, you know, I have regular calls with the ECB on the risk department there, and I'm struggling to think of where the vulnerabilities are in European banks right now. You know, we could name a few, but then not really, not really. We're going to get a correction in the market. Yeah. Absolutely. Is it going to come from the European banking sector? No, I don't think so. It's going to be some geopolitical thing or maybe a rates thing. It won't directly impact European banks, certainly not European banks' credit. What we're talking about, equity is different, but credit, AT1s, they'll drop, they'll come right back up again. So there's a risk of not owning this sector, you know, being out of it and being in cash.
OK, and just where are you finding value in AT1s at the moment?
It's very tricky. You know, my co-manager guy's always looking for these great trades, and at the moment there's such compression. You'll see, like, the Greek banks trading through Crédit Agricole. You know, we did a trade earlier this week, you know, to pick going out of Alpha into Agricole. But where I think the best value is more the second-tier banks. Kind of mentioned it earlier, there's a lot of consolidation going on. And the smaller banks that aren't in the Bloomberg indices, you know, those are the banks where there's a lot of value. They're acquisition targets. You're seeing this slight deregulation in Europe, particularly in the UK. And those are names like, I don't know, Metro in the UK. There's a couple of other names in the UK that we've been buying recently. And you can still get low double-digit returns there.
And just quickly, what are you selling?
Well, I have to say we're selling the Greek banks. I love them, but they should not trade through Crédit Agricole or Lloyds.
All right, Jackie Ineke, CIO of Spring Investments. Lovely to have you for a Mancunian reunion around the table. You'll have to come back. I just want to mark what's happening in the oil market, because you're looking at Brent at $67 a barrel, pairing this loss, and this is after Russia has said that there'll be no current OPEC plus hike talks. So, of course, we were braced for another supply hike, but Russia, for now, ruling that out. So we have Brent weaker, 0.9% in response. We've got plenty else to watch in these markets. The Stock 600 up today, up 0.25% as things stand in this session. But we're seeing some of the weakness for Sanofi. Shares plunging after a disappointing trial for its new dermatitis drug. So we're going to bring you the details on that stock and the disappointment next. Shares down more than 9%. Stay with us. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London, and these are your top stories. Rate cut optimism. Weaker than expected US jobs data cements bets that the Fed will ease policy later this month. Bonds trade higher as calm returns to Europe. Elsewhere, China looks to cool market speculation as concerns mount about a rapid $1.2 trillion rally. Plus, Sanofi slumping after a new eczema drug disappoints in a late-stage trial, sending shares down as much and more than 9%. So, Sanofi shares down sharply after that news. We can get more now with Bloomberg's health reporter, Ashley Furlong. Ashley, how critical is this drug for Sanofi? Because this is a big move.
It's really vital to the Sanofi's pipeline. So the top-selling drug for Sanofi is Dupixent, which also treats similar conditions, atopic dermatitis, asthma, and the hope was that this new drug would somewhat replace that revenue. Dupixent comes off patent in 2031, so everyone's looking to what comes next. Sanofi has a pipeline of drugs, but this was really critical for replacing Dupixent. And the results have really disappointed because they don't meet efficacy of Dupixent.
And is there anything in that pipeline that analysts are thinking could help Sanofi actually make a comeback from this?
Well, it does have a drug for multiple sclerosis that has shown some positive results already. But then earlier this year, it had another disappointment in a drug for COPD, which is a lung condition, a deadly lung condition. And analysts are also a bit nervous about the outcome of that and whether that drug will be approved in the conditions that it wants to be. So there's concern about the pipeline. But it is a significant pipeline, and there are lots of drugs that are still in development. So it is wait and see, really.
Well, yeah, of course, the CEO, Paul Hudson's been really throwing money at all of this R&D. Do you think that this trial is anyway going to hold that back? Do you think it changes the view on M&A at all?
I don't think so. I think, if anything, it might sort of make Hudson even, it's more critical for them to actually find the next blockbuster.
Yeah.
And we've seen already several deals in the past couple of months from Sanofi, and they've said that they have money to do additional M&A. So I think we can expect more of that later this year, potentially.
Ashley, thank you so much for taking us through that. Bloomberg's health reporter, Ashley Furlong. We've seen the shares, as I say, down about 10% in early trading, but down about 18% over the past 12 months. Let's get you to some of the other top stories this morning. President Trump is asking the Supreme Court to uphold his global tariffs in a fast-track case that could reshape trade policy. According to filings reviewed by Bloomberg, the appeal calls for putting the case on a highly expedited schedule with arguments in early November. It follows a federal appeals court decision that said that Trump can't impose wide-scale import taxes by invoking the 1977 law that was designed to address national emergencies. Now, elsewhere, the Trump administration is moving to block 2 Iberdrola offshore wind projects in Massachusetts that are worth nearly $15 billion. A court filing shows that the government's pulling permits for the New England Wind 1 and 2 farms, part of a broader crackdown that's disrupted at least 4 East Coast projects this year. And we have tech industry leaders expected to attend an artificial intelligence event hosted by the First Lady Melania Trump that's happening later today, and then to join the president himself for an evening reception in the newly renovated Rose Garden. Meta's Mark Zuckerberg, Apple's Tim Cook and Microsoft's Satya Nadella are among the invitees. And staying with Apple, Bloomberg has learned that Apple is planning to launch its own AI-powered web search tool next year. Sources say that the company is working on a new system dubbed internally as World Knowledge Answers, and that's going to be integrated into the Siri voice assistant. The move would allow Apple to compete with OpenAI as well as with Perplexity. Now, our next guest sees a future where economic growth won't come through an increase in employment. Eloquent AI is looking to automate complex customer operations in financial institutions and especially in banks. Now, they've just raised $7.4 million seed round in 3 days. Wow. And we can talk now to the CEO and founder, and that is Tugce Bulut. Really good to have you with us, Tugce. Thank you so much for making time for us. Look, we've got everybody using AI now. I wonder, how do you use AI to get the edge in banking?
That's a fantastic question. I'm sure any of us here have called our bank in the last maybe 24 hours, maybe 1 week, and we waited on the line for maybe 45 minutes before we can actually speak to someone. The way the banks use today to completely transform their not only customer support and operations, give a premium level access like a concierge service to every single customer they have, which used to be only a privilege for a few of their customers.
Tugce, you're triggering me here. You're making me think of hold music. But look, what's the difference between what you offer and a chatbot?
The Eloquent AI solution offers an AI operator. It was all a transition. We started with chatbots, but I would admit I found them quite frustrating. You go and start speaking to a chatbot and it doesn't understand what you are saying. You have to press buttons. It's not a natural language conversation. Then we saw agentic AI, which is a little bit better, but the problem was it was simply conversational. it couldn't actually take any actions. It couldn't really respond to the requests you were saying. For example, my ACH transfer is stuck. It's been a couple of days. Why is it not going through? Chatting in those circumstances is not enough. You need to be able to log in to a core banking platform, bring up the customer's account, look at if there's any fraud, if there are any risk flags on it, and click a lot of buttons, make decisions, make judgment calls. That's what AI operator, our Eloquent AI operator, does. It effectively acts like a human. That's why a lot of our customers call it a human API. And it can take all these actions in a very complex, regulated workflow.
But we've been talking about what Apple's doing on AI, what DeepSeek's doing in AI, in just this program, Tugce. So I wonder, when these more generic platforms become more advanced, are you not worried that they're going to overtake you in your own field in banking?
That's a fantastic question, and it's quite interesting. OpenAI's own CFO recently gave an interview talking about the fact that they are not set up, their agentic structure, their generic training is not set up for vertically specialized tasks. And where we see the real moat is that you are doing a job which is for a very specific task, like doing a risk check, sanction screening, alert dispositioning for a bank. And the way we train our own model or RTO can be very opinionated, because we are not trying to solve the problem for every task. We are trying to solve this problem with 100% accuracy and reliability, but for a very specific problem. And you are doing that with proprietary data that is behind the walls. It's not publicly available. It belongs to the companies who are doing these actions. So it becomes quite a differentiating edge.
But you've just talked about a load of jobs that humans usually would be doing. And I speak to economists day in, day out, analysing the latest labour market data, talking about how no one wants to hire or fire at the moment. There's an absolute freeze. And many of them say, look, it's not just about tariff uncertainty. It's also because you've got AI doing human jobs. Is that not the ugly truth here, that what you're offering is going to displace humans' employment?
First starting point, what we are going to see for the next couple of months, maybe for a year, is the companies will be able to double their revenues, triple, grow significantly without going through headcount growth. And in a time where there's so much pressure on the bottom line, that is a very welcome change on the side of the banks. What that means for the overall labor market is we do need to prepare for a new world where work is optional and no longer a precondition for your subsistence. It wouldn't be surprising at all in 2 years, 3 years, we actually move on to a place where us humans get to choose what we do rather than having to do very routine tasks 100 times, 1,000 times a day. In our very nature, we are actually not really built to do those kind of jobs. Our human potential is far greater than that.
Yeah, you just wonder how many of those fun and clever needing jobs are actually out there, to say. But I just want to also take a step back, because you've got a really interesting perspective here. You're headquartered stateside, but you're registered here in the UK. What do you make of the difficulties, shall we say, of being a European tech company and growing compared to if you're an American tech company and growing in this environment?
Absolutely. I mean, just as a starting point, we are a fully American company. We are based in San Francisco and we are registered in Delaware. You're absolutely right. We do also have operations in London. And, you know, I lived in London for many years. There's incredible talent in London that we want to continue to tap into. But we are an American company, and the largest market for this change is being requested in the US. That's why it's quite important to be based there as you are expanding this technology. It's a great starting point. Now, we have fantastic UK customers already. One of them is Clio, for example, also based in the UK, but very successful in the US. And some of these UK companies are also preparing for their IPO or going through incredibly fast growth periods. We are able to support them also being compliant with the regulations here in the UK.
Tugce, we'll have to catch up again next time you're in London. Tugce Bulut, CEO of Eloquent AI. Thank you so much for joining us this morning. Well, coming up on the programme, we are going to stay in the UK. Bank of England Governor Andrew Bailey playing down the surge in long-dated gilt yields and talking down the chances of another rate cut this year. He's had a lot to say, and we're going to discuss it next. This is Bloomberg. Bank of England Governor Andrew Bailey's played down the importance of a surge in long-dated gilt yields, saying that he wouldn't exaggerate the significance of 30-year bond yield moves. Now, he's also cast out on another rate cut later on this year.
Although I think that the path will continue to be downwards gradually over time because policy is still restrictive, there is now considerably more doubt about exactly when and how quickly we can make those further steps.
Well, Kit Rees, editor of Bloomberg's Markets Today live blog's been listening to that testimony, so you don't have to. Kit, what were the other MPC members saying? Do you feel like everyone's as hawkish as the governor sounded there?
Yes, we've definitely been getting a bit more of a hawkish tone from the members for yesterday. So there were comments from Deputy Governor Claire Lombardelli, which people have been focusing on. She said that the rates may need to settle only below 4%, which is the current level. There were also comments from Megan Green, definite concerns over inflation, which seems to be what they're focusing on. So this seems to be chiming with what markets are thinking. We've seen bets paired on a rate cut in November. So this was all kind of fitting into that picture, a very cautious picture. Inflation has been very persistent, and yet there's worries over growth and, possible slowdown in the labour market, which is, again, another thing that the Bank of England is focusing on. So taken all together, it was a bit more hawkish comments. We'll have to see what's going to happen in September at the Bank of England meeting there to see how their thinking has evolved.
Yeah, I'd been dying to hear from Claire Lombardelli. It was her first time speaking and explaining that dissent at the last meeting. Of course, they had to vote again, didn't they? But look, on the fiscal side, now we know we've got this budget coming also in November, end of November, 26th of November. Why have they pushed it back so far when you've got all these moves at the long end of the gilt curve?
Yes, so it's a great question, and it looks like the government will probably want to get a bit more of a steer on what's going on with the economy. So there's obviously lots of worries over a slowdown in growth. As I mentioned, inflation has been persistent, but there's been other signs of weakness elsewhere. So it gives them time to see how things have evolved. There's also a lot of risks with tariffs on the kind of global front, geopolitical risks too. And we've also got lots of data points coming up. We've got inflation, Bank of England meetings, so lots to navigate. So the government will probably be one to see how this all evolves, and then how it will feed into into fiscal policy.
And they're also watching how the situation evolves on the Deputy Prime Minister, Angela Rayner. So she's fighting for her future, isn't she? She's admitted to having underpaid property taxes. You've got to wonder how much concern that political uncertainty is going to cause for markets.
Yeah, markets don't like uncertainty at all, but we haven't seen huge moves just yet. So markets seem to have been quite sanguine. Yesterday things stabilised, seeing a bit more of a stabilisation today. But if we see any further developments on the tax probe, or we see any more kind of concerns over leadership, then that might start to filter in, maybe into the pound too. But looking forward, it's going to be also interesting to see how the domestic stocks perform in the FTSE 250, given they've underperformed this year. So lots to watch, but for now, no big real moves yet.
Well, I'm sure you'll be tracking those moves on the blog. Kit Rees there, editor of Bloomberg's Markets Today. We thank you so much. Now, we've been talking about this reprieve for Treasuries yesterday after US jobs data prompted traders to add to bets on at least 2 Fed cuts this year. But if we zoom out, over the past year, long-end yields have continued to move higher, and Jamie Rush from Bloomberg Economics argues that those higher long bond yields are here to stay. And Jamie's here to stay with me now. Jamie, good morning.
Morning.
Just give us some perspective here, because when we've been talking about, let's say, the wild moves on the gilt curve, It doesn't seem like we're in a Liz Truss moment. So just ground us a bit in what's happened this week.
Yeah, I mean, I think we're not, because if you look at where the action is concentrated, it is, as you say, at the 30-year horizon. Back in the Liz Truss deep, dark times, it was spread across the yield curve. It was, the pound was selling off at the same time. That's not happening this time. So
in a big way.
Not in a material way, yeah. I mean, if you looked at it back then, they were both moving in the opposite direction. So it was bad news. So I think what we're seeing is idiosyncratic factors that are driving yields in like 3 countries. So you've got Japan, UK, France, yield curve control and fiscal in Japan, bit of fiscal here, a lot of politics in France. These are intensifying moves at the 30-year horizon, but it's happening everywhere. It's just that, that it's particularly bad in those countries.
But what's connecting the dots then? You've got, as you say, the Fed story in the US, the fiscal story in France, but it's all happening together.
Yeah, I mean, I think the underlying trend is driven by things that are happening behind the scenes. It's the structural forces which are pushing rates higher over many years, not the current market focus, which is at that 30-year horizon.
And indeed, in your book, your new book, The Price of Money, you've written it with our colleagues Tom Orlick and Stephanie Flanders, which you can see there on the screen. You say that 4.5% 10-year Treasury yields is the new normal. I just wonder how much higher we can go, given all those factors that you're citing.
Well, so I think when you dig into the reasons why interest rates fell over the past and throw them forward, I mean, why do they fall? Demographics. So the baby boomers socking away their paychecks into savings accounts for their retirement. Well, they're retiring. So less savings, higher interest rates. We used to think we lived in a safe world. After the end of the Cold War, defence budgets shrunk, governments were able to save. Well, we don't live in a safe world. Defence budgets are going up, creating more pressure. And if you think about AI as well, I mean, to really benefit from these frontier technologies, you have to throw a lot of money at it. There's a lot of investment. More investment, higher rates. So if you put those things together, I mean, these are not all going to happen at the same time, but they're all pushing upwards on rates. And you can easily imagine a path where instead of sort of 4.5 10-year Treasury yields, you could get to 5 and above, and it's not that hard to picture it.
So in the here and now, we were talking to Eric Lonergan at Calibrate yesterday, and he was saying on the opening trade, look, the sell-off in gilts is more about psychology among investors than, the fiscal concerns that we were talking about. Is that basically what we should conclude?
Well, I think that's broadly right. I mean, the UK is not a basket case. It's not in a significantly worse position than France or the US. The UK is not a basket case. No, there's a lot of positive things to say about the UK, and there's probably some the management of the messaging is probably not quite what you'd like it to be. But I mean, I think the bull case for the UK still stands, and so I wouldn't expect it to be a complete outlier forever.
Well, I'm sure the Chancellor would thank you mostly for that message. Jamie Rush, our Director of Global Economics at Bloomberg Economics, thank you so much. And The Price of Money is published next month, so do pre-order your copy. Well, pivoting to the US, former Treasury Secretary Larry Summers warned that while financial markets have so far shown limited concern with regard to the Fed's independence, the situation could, in his words, turn very quickly. Summers was speaking to Bloomberg TV's Wall Street Week.
What the president is talking about, what he's explicitly scheming about on his Truth Social account and in some of his rhetoric, is getting a majority of the Board of Governors and using that majority on the Board of Governors to force a majority on the Federal Open Market Committee by controlling the appointment of regional feds. So this is not a one and done thing involving just the chairman. This is an attack on the governance of the institution. There hasn't yet been a dramatic market reaction. There are some concerning things in markets, not just 1 year ahead, but 1 year ahead. Inflation expectations are trending up a bit. The spread between the 30-year bond and the 10-year bond is larger than any time since COVID. But we haven't seen substantial reactions in markets yet. But this could turn very quickly if the psychology changes.
Former US Treasury Secretary Larry Summers speaking there. Well, staying with the Fed, it says that US economic activity saw, quote, little or no change across most of the country in recent weeks. Traders are hedging their bets on Fed cuts later, a Fed cut later this month, with Friday's payroll data seen as pivotal for year-end bias. Let's bring in our Ven Ram MLive strategist, of course. Ven, good morning. What do we take away, first of all, from the latest Beige book and the JOLTS data yesterday? Because it looks like this is what's supporting the Fed cut bets and the market this morning.
Morning, Lizzie. Absolutely. I think that the big takeaway from the Fed Beige book was that, look, economic activity is more or less stagnant in the world's largest economy. Most of the districts reported flatlining economic activity, but at the same time, they are concerned about the increase in price rises. They're concerned about wages not keeping up with inflation, and that continues to be that will be a key driver of the markets going forward, I think, because much of the inflation that is going to come down the pike, I don't think is fully factored in by the markets. So I think that, the Fed is going to cut rates from to all intents and purposes. Yesterday, we saw the JOLTS report showing a softening of economic activity as well, and softening of the labor market as well. So I think that the Fed is now more minded about the employment aspect of its mandate. So I think that they are going to cut rates. Let's see what this leads to.
Well, could the payrolls data tomorrow open the door to a 50 basis point cut in September?
Well, I think that that is unlikely to happen unless we get a contraction in the jobs market, which, of course, no one is expecting. If the jobs market data prints as expected around 75K, I think that we should probably get ourselves ready for a 25 basis point cut, which is what the market expectations are. I don't think there is really a case for a 50 basis points jumbo rate cut yet. There's nothing in the economy that is screaming for a rate cut as big.
So is the bond market sell-off now done, then?
Well, it has happened in fits and starts this year, Lizzie, really. We saw one episode in January and then one in April in the UK. And this week's selling has certainly abated, and it looks like it is going to be contained for now. But, come the end of November, when Chancellor Rachel Reeves is going to unveil an autumn budget, I think there are some very uncomfortable questions for the government to answer in vis-a-vis the gap in the government finances. So I think that as that comes into the crosshairs, I think that gilts will once again come under focus, especially the long end.
Well, yeah, she's picked the day before Thanksgiving, then, a time of low liquidity. Surely that's going to wreak some issues in the market.
Absolutely, and I think that much of the selling may in fact happen before she unveils her autumn budget. But of course, she's chosen the time, and which, as you mentioned, colludes into a period of low liquidity. So I think that, it's going to be a very jittery year-end for the gilts market, specifically those who are positioned at the longer end of the curve.
All right, our MLive strategist, Ven Ram, we thank you so much for that analysis. Do check more of it out on the MLive blog. But that does it from me with the Pulse. Coming up next, Bloomberg Brief. We'll hand over to Vonnie Quinn. So stay with us. This is Bloomberg.